The illusion of the obvious. If you wish to command the market, not as a gambler hoping for fortune, but as a disciplined observer seeking truth, you must first accept a fundamental reality. The market rarely declares its true intentions aloud. Its great movements are conceived in silence, beneath the deceptive surface. What appears random or chaotic to the undisciplined eye is in truth an intricate dialogue between supply and demand, accumulation and distribution, strength and weakness. Most who enter its arena never grasp this. They are mesmerized by the noise, the incessant buzz of news, the endless opinions of analysts, the seductive lure of narratives. They interpret surface ripples as deep currents and confuse commentary for causation. In their haste to explain, they forget to observe. Yet all that the market truly is, all that it ever reveals, is written right there in front of them, in the naked honesty of price and volume. But few can see it, for to see, one must first unlearn. To hear the market speak, one must first quiet the incessant voices of bias, emotion, and ego. The market's silent voice. The market does not communicate through articles, forecasts, or product announcements. Its language is the rhythm of its own trading, the interplay between price and volume. Each tick is a syllable, each wave a sentence, and each trend a story written in real time. To the uninitiated, these fluctuations seem senseless. To the trained eye, they are filled with meaning. Price shows us what the market is doing. Volume tells us with what conviction it is being done. Together, they unveil the invisible infrastructure of demand and supply, the tug-of-war between weak and strong hands, between ignorance and insight. This is the first law of intelligent speculation. Price and volume are not outcomes of opinion. They are the reality beneath opinion. Where volume expands, conviction grows. Where it evaporates, enthusiasm vanishes. A seasoned observer does not chase a rising price simply because it is rising. He watches whether volume agrees with price, whether the market's energy supports or contradicts its movement. For price can lie, but volume rarely does. It is the heartbeat beneath the skin. The discipline of observation. The apprenticeship of speculation begins not with execution but with observation. The speculator's main task is not trading. It is listening. In the early years of every great operator's career lies a long period of silence. Hours spent watching the tape, studying charts, absorbing every shift in price and rhythm until instinct replaces impulse. The ticker becomes a teacher. This phase of study often appears tedious to outsiders. It is not filled with constant excitement or visible progress. Yet it is here that the mind is sharpened, detachment is forged, and emotional discipline begins. Observation builds an internal library, a subconscious record of recurring behaviors, repeated traps, and consistent patterns that later manifest as intuition. Observation without action is not weakness. It is preparation. The speculator who waits learns far more than the one who leaps. The crowd believes that trading is doing. The professional knows that trading is waiting, until the market itself provides undeniable confirmation. Beyond the news, the great deception. Perhaps the most costly delusion in market history is the belief that external news drives prices. Every era repeats this fallacy. Traders hang on government statements, corporate earnings, and economic forecasts, believing that these dictate the direction of price. But the truth is the reverse. More often than not, price precedes news, not the other way around. Smart money acts before events become public. The accumulation or distribution that builds days, weeks, or even months before the headline is the real story. By the time the world reacts to the news, the decisive move has already occurred. The informed speculator knows this well. He does not waste energy dissecting headlines. He watches the market's reaction instead. When good news produces weakness, distribution is underway. When bad news fails to break a price down, accumulation is occurring. The market's response, not the narrative, reveals the truth. Thus, the price is the reality. The news is merely its echo. The laws of supply and demand, underlying every chart, every surge and collapse, is the unchanging tension between supply and demand. Nothing else matters. When demand outstrips supply, price rises. When supply overwhelms demand, price falls. What distorts this simple truth is the concealment of these forces. The way the powerful accumulate quietly before an advance or distribute stealthily before a decline. Accumulation. Accumulation is the quiet gathering of shares by informed interests in anticipation of higher prices. It seldom reveals itself through dramatic movement. Instead, it appears as a subtle firmness, a refusal to decline despite general weakness. Volume gradually builds as the stock absorbs selling without faltering. Every dip is met with immediate buying. The market appears dull, but something powerful is stirring beneath. The laws of supply and demand, underlying every chart, every surge and collapse, is the unchanging tension between supply and demand. Nothing else matters. When demand outstrips supply, price rises. When supply overwhelms demand, price falls. What distorts this simple truth is the concealment of these forces. The way the powerful accumulate quietly before an advance or distribute stealthily before a decline. Accumulation. Accumulation is the quiet gathering of shares by informed interests in anticipation of higher prices. It seldom reveals itself through dramatic movement. Instead, it appears as a subtle firmness, a refusal to decline despite general weakness. Volume gradually builds as the stock absorbs selling without faltering. Every dip is met with immediate buying. The market appears dull, but something powerful is stirring beneath. Distribution. Distribution is its opposite, the systematic unloading of positions by strong hands to the unsuspecting public. Prices may still be rising or holding near highs, but the upward thrust begins to lose energy. Volume expands on stagnation. Each rally is shorter, each reaction heavier. The smart money is leaving quietly, while the crowd cheers the apparent strength. Learning to detect these footprints is not an academic task. It is an art born of watching thousands of charts until subtle distinctions speak loudly, until what once seemed random becomes recognizable. When you learn to see accumulation forming at bottoms and distribution forming at tops, you begin to read the market as effortlessly as others read a book. You cease to ask, why did it move, and instead start asking, who was moving first? Volume, the truth teller. Volume confirms or denies everything. Without it, price is a rumor. With it, price becomes undeniable evidence. A strong move on expanding volume is the market declaring its conviction. A rise on weak participation, however, is a mirage. Volume is not just numbers. It is the crowd's heartbeat. Low volume means apathy. High volume means engagement. And in the choreography of speculation, engagement precedes explosion. When studying volume, the question is never how much, but when and why. Did volume increase on rallies and shrink on reactions? That is strength. Did volume grow on declines and vanish on rebounds? That is weakness. Understanding these rhythms converts confusion into clarity. It transforms trading from mere guessing into measured interpretation. For volume, in its pure objectivity, cannot lie. It records participation and reveals conviction. Support, resistance, and the points of decision. Support and resistance are far more than chart decorations. They are psychological battlegrounds, visible records of previous conflict between buyers and sellers. Support represents a price area where buyers previously overwhelmed sellers. Resistance represents a zone where sellers halted an advance. When price revisits these levels, the market's behavior there speaks volumes. If support holds firmly on heavy testing, buyer conviction remains. If resistance breaks decisively on volume, supply has been overpowered. If either fails quickly, control has shifted. A breakout, a forceful move through resistance on strong volume, is one of the clearest declarations of imminent trend. Likewise, a breakdown below long-standing support signifies the onset of weakness. Yet one must confirm each with follow-through. The market loves to deceive impatient players with false breakouts, quick surges designed to trap eager participants before reversing sharply. The disciplined speculator never acts on the first movement. He waits for confirmation, for when the market speaks clearly, there is no need to rush. Truth, once revealed, sustains itself long enough to act upon. Consolidation, the market's quiet preparation. Contrary to appearances, The periods of stillness are often the most important. A narrow trading range, a consolidation, is the market's equivalent of a coiled spring. Here, energy builds invisibly as supply and demand find balance. To the impatient, such phases seem dull. To the wise, they are the crucible of opportunity. When a stock refuses to decline in a weak market or repeatedly tests an upper boundary without retreating, hidden accumulation is taking place. The longer and tighter the range, the greater the potential energy trapped within. When the eventual breakout comes, it is rarely gentle. It is sudden, violent, and unmistakable. This is why patience pays more than prediction. Opportunity grows silently. Divergences of strength. Markets seldom move in perfect harmony. At key turning points, a few perceptive stocks or sectors begin to defy the general trend. During declines, some quietly strengthen. During booms, some begin to lag. These divergences are not anomalies. They are valuable whispers of impending change. A stock that refuses to fall during a broad sell-off is waving a flag. It is being silently accumulated. Conversely, a stock that weakens while the rest of the market rallies is under hidden distribution. Observing these disparities provides priceless foresight. Leaders rise before the crowd. Laggards fall before panic sets in. Comparative strength analysis, the act of measuring relative performance, is thus an indispensable skill. It allows you to glimpse the next major trend while others are still trapped in the last one. False breakouts and market traps. The market, like any master strategist, relies on deception. False breakouts and fake reversals are its weapon of choice. Their purpose is simple: to mislead emotion-driven participants into taking positions that fuel the real move. A classic trap unfolds when price punctures a key level, a breakout that seems too convincing to doubt. The herd floods in, but instead of continuation, the move stalls and reverses. Those who entered late are now trapped. Their exit orders become the fuel driving the reversal in earnest. To avoid such traps, a speculator demands proof. Does volume genuinely support the move? Does price hold above the breakout level after initial enthusiasm fades? A false move is self-revealing because it cannot sustain participation. The market's true direction is often found in the reversal after the failed signal. These episodes reward patience and punish haste. In speculation, timing is everything, but timing is born of confirmation, not anticipation. Change of character. When the music shifts, every stock possesses a certain rhythm. Perhaps it rallies sharply, corrects modestly, then rallies again. Or perhaps it declines quickly, then pauses before another fall. When this rhythm changes, when rallies weaken, corrections deepen, or previously dependable behavior falters, the market's character has changed. This change of character is one of the earliest signs of a coming reversal. It signals a transformation in underlying demand. The smart observer does not dismiss it as random volatility. He recognizes that some invisible balance has shifted. A market that starts hesitating on good news or dropping on light selling is revealing fatigue. Likewise, one that suddenly strengthens on bad news is announcing hidden accumulation. Changes of character often whisper long before trend lines or news confirm what is happening. The test of supply. Among advanced observers, there exists one particularly powerful insight: the market's ability to absorb supply. When selling pressure arrives and price refuses to fall, that is strength of the purest kind. Such behavior reveals that every share being sold is immediately met by eager buying buyers of conviction. This phenomenon appears frequently before major advances. The stock seems bound by gravity, yet never breaks down despite abundant volume. It is as though an unseen floor has formed beneath it. That floor is accumulation by strong hands. The same is true in reverse. When a market absorbs buying yet refuses to rise, hidden distribution is at work. The speculator trained to recognize absorption need not guess direction. He sees the battle being won in real time. The point of least resistance. After periods of indecision and preparation, there comes a moment of unmistakable clarity. The point of least resistance. It is the instant when all forces align. Accumulation complete, supply exhausted, and the path ahead unobstructed. The market declares, "Now the way is open." To the disciplined, this signal is unmistakable. A decisive breakout from consolidation on strong volume, supported by structural confirmation from broader indices or related sectors. It marks the birth of a trend, the precise moment to strike. Most traders act too soon, guessing at direction. The wise act only when the market itself reveals the way. Waiting may appear passive, but in truth it is the culmination of strength. For when the signal arrives, the opportunity is both clear and forceful. The reward for patience is conviction. At this point, emotion must give way to execution. The disciplined speculator acts swiftly, not recklessly, guided by the certainty of confirmation. Decisive action and the psychology of execution. To perceive opportunity is one thing, to act upon it is another. Many falter at this junction, trapped between conviction and hesitation. Courage without discipline is gambling. Discipline without courage is paralysis. Both are fatal. Once the market offers confirmation, action must be immediate and decisive. Delay dilutes the asymmetry you have so patiently built. The greatest profits are not earned by perfect ideas, but by precise timing aligned with the market's own declaration of intent. Execution, however, also demands humility. Every decision must be accompanied by a clear stop, the rational acknowledgement that you may be wrong. Risk management is not fear. It is respect for uncertainty. A true speculator welcomes small losses because they serve as tuition, proof that discipline has triumphed over ego. But hesitation after confirmation or stubborn refusal after denial is fatal. He who cannot cut quickly will not last long enough to profit when he is right. The first probe, testing the market. When the market remains ambiguous, a wise speculator employs a tactical weapon, the first probe. A small, deliberate position designed not to profit but to test this minimal action compels the market to answer a question. Is my reading correct? If the market responds favorably, moving smoothly in the intended direction, even slightly, conviction increases. The speculator may then add cautiously as confirmation builds. If the market resists or moves against the probe, it reveals error. The probe is closed swiftly, the cost accepted as negligible. This practice transforms uncertainty into feedback. The market itself becomes your mentor. By treating small losses as informational, the speculator evolves continuously, reducing error and refining timing. The first probe teaches humility, precision, and responsiveness. It ensures capital is committed only when the market has spoken. Timing over price. Many traders obsess over obtaining the cheapest entry price, as though pennies matter more than precision. In truth, perfect timing outweighs perfect price. A stock may appear cheap while still burdened by overwhelming supply. It may become cheaper yet. The professional does not seek bargains, he seeks confirmation. To buy slightly higher, when the market has declared its strength, is infinitely safer and more profitable than buying early in hope. The difference between success and failure often lies not in 2 points of price, but in 1 moment of timing. It is far better to pay a premium for alignment with the trend than to suffer a discount for opposing it. The market rewards synchronization, not contrarian arrogance without evidence. Wait for strength, then move decisively. Timing over price. Many traders obsess over obtaining the cheapest entry price, as though pennies matter more than precision. In truth, perfect timing outweighs perfect price. A stock may appear cheap while still burdened by overwhelming supply. It may become cheaper yet. The professional does not seek bargains, he seeks confirmation. To buy slightly higher, when the market has declared its strength, is infinitely safer and more profitable than buying early in hope. The difference between success and failure often lies not in 2 points of price, but in 1 moment of timing. It is far better to pay a premium for alignment with the trend than to suffer a discount for opposing it. The market rewards synchronization, not contrarian arrogance without evidence. Wait for strength, then move decisively. Panics, booms, and human extremes. At the extremities of every market cycle lie 2 emotional frontiers: panic and euphoria. Both are governed by the same universal law, mass emotion driving mass misjudgment. During panic, fear reigns supreme. Even the strongest hands tremble. Prices plunge beyond logic. News grows apocalyptic. Yet beneath that chaos, informed capital begins its quiet work, absorbing shares discarded in despair. The moment of maximum pessimism is also the point of greatest opportunity. When the market ceases to fall despite relentless selling, the bottom is near. Conversely, during booms, ecstasy blinds reason. Caution evaporates, volume explodes, and every participant believes the ascent eternal. Yet even as optimism peaks, the largest operators begin the quiet process of distribution. They sell into enthusiasm, preparing for the reversal the crowd refuses to imagine. To the disciplined student, these extremes are not confusing. They are clarifying. They mark the emotional limits of the market's pendulum, signaling imminent reversals. The speculator who can remain detached amid hysteria, who sells when others cheer and buys when others despair, transcends mere reaction. He becomes an architect of opportunity. The cost of ignorance. Ignorance in the market extracts a heavy, relentless toll. Those unwilling to study its true language, to read price and volume, to distinguish accumulation from distribution, to recognize deception from genuine intention, are doomed to perpetual defeat. The uninformed trader trades opinions, not realities. They react to headlines, to gossip, to emotion. Their timing is always late, their conviction borrowed, their results erratic. Each cycle erodes both capital and confidence. Worse still, the ignorant suffer the market's deliberate traps, false breakouts, manipulated stories, manufactured volatility, devices crafted precisely to exploit their blindness. Those who refuse to learn are simply fuel for those who have. The market does not punish ignorance out of cruelty, but out of nature. It rewards the informed and disciplined because it must. Every system governed by competition elevates competence and eliminates carelessness. In trading, ignorance is not neutral, it is fatal. The price of knowledge is time and effort. The price of ignorance is everything. The cultivation of the market mind. Mastering the market is not solely about technical skill. It is a transformation of the mind itself. The true speculator cultivates three qualities. 1. Detachment, freedom from fear, greed, and external influence. The market must be observed objectively, as one watches the tide, without judgment or emotional interference. 2. Discipline, adherence to method under pressure. Plans must be executed regardless of feeling. Rules must govern where instinct alone may err. 3. Observation, continuous learning through watching, testing, and refining. The market is an endless teacher for those who listen quietly. Over years, these principles fuse into something greater. A deep internal compass attuned to the market's hidden rhythm. Patterns once invisible become obvious. Subtle shifts announce themselves intuitively. This is not mysticism, but mastery born of immersion. The trader ceases to think in terms of trades and begins to feel in terms of probabilities. He moves in harmony with the tape, guided not by noise but by evidence. The personal market compass. Through rigorous observation and experience, every seasoned speculator develops a personal compass, a near instinctual ability to sense the market's true direction. It is not clairvoyance. It is the fusion of thousands of cumulative insights, patterns recognized, reactions measured, setups tested. This compass allows calm amid storm, tells you when to watch, when to act, and when to abstain. You begin to sense the subtle tension before an explosion or the quiet exhaustion before collapse. You recognize the character of accumulation, the sincerity of breakouts, and the absurdity of panics. Your compass becomes your independence. You cease to rely on analysts or forecasts. You are guided by the market itself, and by your mastery of its language. Conclusion, the journey and the reward. The market is not an enemy to be conquered nor a puzzle to be solved. It is an organism to be understood, a mirror reflecting the total psychology of mankind. Within it reside greed, fear, intelligence, and folly, all in constant equilibrium. Mastery comes not to those who predict, but to those who perceive. To those who listen more than they speak, observe more than they act, and strike only when the market itself confirms their thesis. To learn this language, the dialect of price and volume, of strength and weakness, of truth beneath illusion, is to step beyond the crowd and into a rare fraternity of understanding. It is the art of reading whispers before they become shouts, of aligning with power before the obvious becomes public. It is a lifelong discipline, demanding humility, diligence, and patience, but its reward is profound. The ability to operate independently of opinion, the freedom from emotional slavery, the confidence to read the market's pulse and act in harmony with its truth. In the end, market mastery is not merely about wealth. It is about clarity, the transformation of chaos into comprehension, of reaction into foresight. Few attain it, for it requires the rarest of virtues, the patience to wait, the humility to learn, and the discipline to listen. Those who do command not the market but themselves, and that, in the eternal theater of speculation, is the greatest victory of all.